foreign institutional investors who rushed back to the Indian markets after the Lok Sabha elections took another U-turn soon after the Union Budget 2024 was presented on July 23rd. FIIs had bought shares worth 25,000 crore rupees in July until the budget announcement. However, in the next three sessions, they have pulled out close to 10,700 crore rupees. Now, despite being net buyers this month, this sudden exodus has left investor community wondering what triggered this reversal. Experts cite both global and local factors for the selling spree of FIIs. Starting with the most notable one, in fact, the Union Budget 2024. In a speech, Finance Minister Nirmala Sitharaman announced significant changes to the capital gains tax for listed and unlisted shares. Long-term capital gains tax was raised from 10% to 12.5% and short-term capital gains tax from 15% to 20% effective immediately. Additionally, the securities transaction tax on sales of options has been increased from 0.0625% to 0.1% of the option premium value. For futures, this tax has been hiked from 0.0125% to 0.02% of the prices of the future. Experts believe this double whammy makes it challenging to generate expected returns, prompting FIIs to realign portfolios and book profits. Others attributed this pullback to some earning misses in the first quarter of financial year 2025, an overheated market following this sharp surge we witnessed post-elections, and global uncertainties, particularly the upcoming US presidential elections. Some analysts are also concerned about the uncertainty over the US interest rate cuts. Fed Chair Jerome Powell has indicated that the US central bank will remain data dependent when deciding on policy rates. According to the latest Reuters poll of economists, the US Fed may cut rates twice this year, first in September and then again in December. While easing inflation could prompt the Fed to consider cutting interest rates, resilient US consumer demand is also a factor they must consider. So considering all these factors, should you follow the FII's playbook and book profits too? Looking at how the markets has responded to each dip recently, with constant fund infusion from domestic institutional investors and retail investors resulting in quick turnarounds, it may be prudent to view this correction as a turbulent phase rather than a full-blown crash. That said, stock valuations in the Indian market is very high compared to the 10-year historical average. This, along with some budget announcements such as hike in capital gains tax, may dampen sentiment in the short term. Yet, the combination of 7% GDP growth, 15% annual returns on the Nifty, a stable currency, moderating inflation, and buoyant retail participation may keep sentiment strong in the long run.